Hello options traders, welcome everyone. In this video I wanted to talk a little bit about collars or verticals. Now it's a little bit of a follow-up from the last video where I talked about collars for credits. And anytime you're talking about credit type of trades, it's always a big source of errors because everybody thinks that credits are better than debits. So that was the purpose of that video, but now I've received some emails for people saying, but wait a minute. If collars share the same profit and loss diagram as a vertical spread, why should we even entertain the use of a collar when we can do exactly the same thing for a whole lot less through a vertical? So let's take a look at when you should perhaps consider collars or verticals. So if you recall from that video, I said that collars are generally used by long-term investors, and you have to buy the shares of stock. You're going to buy a put as a form of insurance to guard those losses. But rather than just buying the put outright, you're going to sell a call to help pay for that put. By selling the call, however, you've now given up some of your upside gains on the stock. But if you do these three trades right here, this long stock, long put, and short call, your profit and loss diagram will be identical to a vertical spread. So let's take a look at a couple of examples. First of all, let's compare the prices with the collar. Let's say the stock is trading for 105 and you buy the $100 put for 50 cents. Now that $100 put's going to be fairly cheap because it's 5 points out of the money. And let's say you sell the 105 call, which would be the at the money, and receive 250. And the difference between these two is a credit of $2. And that's because we're receiving $2.50 here. We're taking some of that cash and buying this put for 50 cents. And that gives us a net balance or cash to us of $2. However, overall, notice that it still results in a net debit of 103 because we had to buy the shares of stock at 105. I balance it out with this net credit of 2, and that gives me an overall debit of 103, which is the same thing as saying $10,300 for the total package. Now, if we do this trade, this collar right here, we're going to get this profit and loss diagram. Most I could lose is 3, and the most I could make is 2. Okay, so keep this one in mind, and let's now go check out the 100-105 vertical spread, which would be a debit spread. So now on the last example, that was technically a credit spread, even though we were using calls and puts. And that's the beauty of understanding synthetics. I can still see that as a vertical spread as a credit. So if the credit spread is trading for $2, the 100-105 call spread must be trading for 3, or $300 total. So if I spend $300 for this vertical spread, and the most it could be worth is the difference in strikes, or 5 points, that can also put $2 in my pocket. So if I do this trade right here, this vertical spread, this is what my profit and loss diagram looks like. Most I can lose is 3, most I can gain is 2. Look familiar? Well, let's go do a comparison between the two. Here was the collar we saw previously, and here's the vertical spread. Do you notice anything different about them? You can't, because they are exactly the same thing synthetically. Well, again, that's what this person's question was. Why should we use the collar? Well, notice that when we did this, at least in this example, the collar was a 103 debit, and the vertical spread was a $3 debit. So by buying the $100 call, though, you are borrowing the $100 strike. Now, I've got borrowing in quotes because it's not really a true form of borrowing. You're not going out and taking out a loan. It's not a margin trade. But mathematically, that's what you're doing. And the reason is that when you buy that $100 call, you don't have to buy the shares at that time. You can wait, if you choose, all the way till expiration, exercise the call, and then spend the 100. You get to float the strike price. And that's why options have a mathematical leverage to them, or a mathematical borrowing component. So the thing that you'll want to notice here for the collar is that the net debit on the collar will always be higher by the strike of the put. So in this example, notice that our vertical was trading for 3, but the collar, we had to spend 103, exactly $100 more. Why? Because the person who bought the vertical spread was also buying the $100 call. They're floating the 100. They're not actually spending it today. Also notice that I could attach a loan to this trade right here. If this trader here, let's say, borrowed technically what's called the present value of that $100 strike. So maybe they borrow $99 and have to owe $100 at expiration. Then they've spent $3 plus they've spent $100 for the loan and therefore spent $103 in total. So again, the vertical spread trader is doing exactly the same thing. They're just not borrowing the money, and this is really the key difference. So what's the difference between the collar and the vertical? Well, it comes down to a question of risk. In this example, the debit spread, we could make $2 on a base of 3, right? We had to pay 3, we could make a maximum of 2. Well, that's a 66% return on our money. But if we did the collar, I can make the same $2, but I had to pay $103 to do it. And that's only a 1.9% return on my money. But the difference again is that with the collar trade, there is no borrowing involved. So if the stock falls below our $100 strike, whether it's the $100 put in the collar or the $100 call in the vertical spread, the vertical spread trader loses 100%. The collar trader loses just 2.9%. So he's still in the game. And see, this really highlights the risk that a lot of people inadvertently step into with options. So as an extreme example, let's say they put $300 into an account, they put this vertical spread on, and the stock falls below 100 and they lose everything. There's just nothing, it's gone. And if they did this over and over and over, they'd have nothing to show for it. But if we did the collar, it forces us to have that cash in the account. And so here, if the stock does fall below 100, the collar trader's just down 2.9%. He still has the shares to show for it. He's still in the game. He's just down a little bit. And he could even do another collar the next month. In addition to this, the collar trader also gains the dividends. He's long the shares. So that's going to also enhance those returns. So the main thing to understand is that when you're using vertical spreads, verticals involve a greater use of leverage. And yes, that means you can get bigger gains, but it also means there are potentially bigger losses. So if you're using vertical spreads and you don't have the equivalent of those shares amount in cash, then you are absolutely taking a much greater risk, even though your risk profiles are identical. Now that might seem a little bit of a mystery too, but for those of you who have seen the other videos on the put-call parity, and they're in this forum as well, if you want to go back and review them, you'll recall that there's two different versions of put-call parity. There's one that's called the mimicking portfolio, where we just look at the stock, the long put, and the short call. And then there's another one called the replicating formula, where we look at the stock, the long put, the short call, and we make it equal to the bond. Why do we make it equal to a bond? Because if you want to truly mimic those portfolios, you've got to account for the borrowing. And if you're not doing that, you could potentially be stepping into traps, even though the profit and loss diagrams appear to be identical. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.